In recent times, tensions between the West and China have been on the rise. This goes beyond just trade disputes, we're talking about tech rivalry, spying allegations, and more. These developments have far-reaching consequences for the global markets. Let's delve into how this situation is shaping our economic landscape. U.S. President Joe Biden is keen on bringing back strategic manufacturing sectors like electric vehicles and semiconductors to the United States. This move, while having its merits, could lead to inflationary pressures. The world's largest chipmaker, TSMC, is already shifting some production to Germany. This shift might not be without costs, and it could potentially impact inflation rates and interest rates. Goldman Sachs research found that bringing production home may have inflationary repercussions, particularly if Western manufacturing does not ramp up quickly enough to offset declining imports. Now, let's talk about an interesting concept, friendshoring. It's all about replacing China's role in supply chains with nations that have friendly relations with the United States. In simpler terms, it's like shifting the sourcing of products and materials away from China and towards countries that the U.S. considers its friends. So far, research led by Harvard Business School has pointed to nations like Vietnam and Mexico as major beneficiaries of this shift in the U.S. supply chain strategy. This move not only affects trade dynamics but also provides fresh growth prospects for these friendly nations. Emerging markets' growth prospects are analyzed through this new lens. India is emerging as a strong contender in low-cost, large-scale manufacturing, offering a youthful population and a burgeoning middle class. This presents opportunities for multinational companies seeking alternatives to China. Indian stocks have shown a notable 8% rally this year, and the inclusion in a key government bond index by J.P. Morgan is poised to boost investor flows. India's central bank forecasts that the economy will expand 6.5% this fiscal year, while China is expected to grow around 5% this year. Barclays reckons that if India raises its annual economic growth closer to 8% over the next 5 years, it would be in a position to become the biggest contributor to global growth. The tensions between China and the West have consequences for various industries. The EU is considering tariffs on Chinese electric vehicle imports, while U.S. semiconductor manufacturing subsidies are benefiting companies like Intel. However, big U.S. tech stocks and global indices are susceptible to Chinese retaliation. Luxury fashion houses are also caught in the crossfire, with higher levels of scrutiny impacting spending habits of affluent Chinese consumers. China's economic challenges extend beyond political tensions. Ongoing tariffs and restrictions on investing in Chinese technology add to the complexities. Investors find themselves at a crossroads, torn between caution and the potential for opportunities in this market. A J.P. Morgan survey of credit investors found that 40% were bearish on China, but almost the same proportion wanted to increase allocations. The China-West tensions are reshaping our global economic landscape in significant ways. From inflation concerns to emerging market opportunities, the effects are broad-reaching. Navigating these waters requires a careful consideration of risks and potential rewards. Stay tuned as we keep you updated on how these developments continue to unfold.